Well, hey guys. Well, we've made it through the last exam covering chapters 20, 21, and 22 and budgeting. For the most part, everybody did pretty well on it, and you're hammering away at the homework, so that's good. We just have this last leg of the class to cover. It's just the last two chapters, chapters 23 and 24. They're not really related to each other like the last chapters were, all having to do with budgeting. They're two somewhat different subject matters, but I don't think they're very difficult. Of course, you'll need to spend some time with them and look at the homework. But I think we've covered the more difficult material in this course. But we've got 2 weeks left. We've got this week, and then next week, and then of course half of the following week. So we've got 2 weeks from today is going to be your final exam. It's due on Wednesday night, May 20th. So we've got a couple weeks to get this done. My goal is to actually finish, or to get this chapter and the next chapter loaded probably by Monday or Tuesday. I'm going to finish this chapter up this week, so you can be working on that, and then you'll have the next chapter available to you as well. So anyway, let's go ahead and get started on chapter 23. I foresee this being 2 videos, perhaps 3. I don't want to get them too long. But anyway, this has to do with the chapter is called Relevant Costing for Managerial Decisions. And basically, this is just decision making. It's a decision making chapter. Should I or shouldn't I? And of course, business owners and managers of businesses are always faced with that question. Should I replace the copier? Should I replace a production machine? Should I replace an employee with a machine? Should I buy a new forklift? Should I open a new office downtown? There's always these questions. And from the accountant's point of view, the first thing we look at is the finances of it. Can we make money? What's it gonna cost? What's it gonna save? What's the bottom line in profits that will come from the different decisions? So that's what we're going to be looking at is what we should consider in making decisions, what revenues and costs we should consider, and then we're going to look at various decisions that can be made. Such as taking on special orders at a special price, making or buying component parts for something I'm producing. If I find some products that I made that are defective, should I scrap them or should I rework them and try to get them better? Sell or process further. We're going to be looking at sales mix, segment elimination, which we've already seen a little bit of, and keep or replace a machine, product pricing. So we're going to be looking at these various decisions. But first, let's look at this. We got to get some definitions down and talk about what some of the and what the process of decision making is. So here's the process in any decision making, and it's really very straightforward, but it makes for an excellent multiple choice question. But in making a decision, when a manager or a business owner is posed with a problem, if they come up with some kind of an issue, they have to basically define the task or goal, or identify the decision that needs to be made. Is how I would state that, is just recognize that there is alternative courses of action that I can take with regard to whatever my decision is. So define what it is that we're talking about. And know what the goals are. Are the goals to retain as many employees as I can, or to save as many lives as I can, or to increase the bottom line, the net profit, as much as I can? And so what's my goal? Second, what are my choices? Identify the alternative actions. What are the different things that I can do? Sometimes the decision is yes or no, but then sometimes it may be I may have half a dozen different things that I can do, so I have to identify what are my choices. Third, collect relevant information. That is, make sure that we have all the facts with my various courses of action, because if I don't have all the facts, and I could make a wrong decision and have something come up that, oh, well, I didn't consider that. Well, that's what we want to try to avoid, is making that excuse. Oh, I didn't think of that. No, we want to gather all the relevant information. Based on that relevant information, we need to select a course of action. And that course may be to do nothing, but whatever it is, we need to make a choice, and then we follow up on it. after we've implemented that or after we've made that choice, analyze and assess how effective that decision was for purposes of basically either because it helps me, that feedback helps me become a better decision maker. Did I recognize all the facts, or did I miss something? I don't want to make that mistake again. Or, it may not be too late. I may be able to change to one of the other courses of action as well. So the decision shouldn't be final and then never thought of again. So very logical portrayal of information here, and the steps that we take in making a decision and following up on it to see how we're doing. We're going to be looking at the financial aspects of it, because as accountants we are financial, but we also want to look at the non-financial information, which we'll talk about later in the chapter. We want to make sure that the non-financial information, the people that are laid off, the lives that are placed at risk, or the quality of the product, these are all non-financial aspects of my choices. I want to make sure that those don't outweigh the financial aspects. A couple definitions that are going to be very important here. We want to understand what are the relevant costs and benefits. And the costs, of course, are expenses, and benefits are revenues. Now, these relevant costs are sometimes called incremental costs. And the definition of an incremental cost: an additional cost only if a company pursues a specific course of action, which means basically it's a cost that's different among alternatives, that it's a cost that's there if I decide to do this, but if I decide to do something else, it's not there. It's different among alternatives. An example would be leasing or buying a car. And that's a choice that a lot of people have to make personally, and a lot of companies have to make. Should we lease our automobiles or should we buy them? Well, one of the costs of leasing an automobile are the lease payments. You have to make lease payments. Now, if I decide to lease it, I'm going to have to make those lease payments each and every month. But if I decide to buy it outright, I won't make that lease payment. So that's an incremental cost. It's there under one alternative. It's not there under the other. That's an incremental cost. How about the gasoline? If I'm trying to determine whether to lease or buy my delivery trucks, how about the gasoline that I'm going to be putting into it? That's not an incremental cost, because I'm going to have to pay for gas if I lease it. I'm going to have to pay the same gas if I buy it. Same truck. I'm just trying to determine whether to lease or buy it. So the gasoline costs or the insurance, those are not incremental costs because they are not different. They are present among both alternatives or all alternatives. So what we want to do is we want to look at just the incremental costs. What will change? What would be different under each of the decisions? And relevant benefits is the same thing. Would revenues be affected? If the revenues are different among alternatives, then that's an incremental revenue. If it would not be different, then it is not an incremental. For example, if I sell some of my products to a person across the country, and they're going to pay me $100, so that's my revenue. I'm selling it for $100. Now I have to determine whether I should ship it overnight, which is going to cost me $20, or ship it 3-day shipping, which is only going to cost me $10. That's my decision. Should I ship it overnight, $20, ship it, or ship it 3-day, $10? Well, the shipping cost, that's an incremental cost. It's different among the alternatives, but the revenue's the same. I'm getting $100 if I ship it overnight. I'm getting $100 if I ship it 3 days. So that's not an incremental revenue. However, if I'm going to charge more if I ship it overnight, then it would be an incremental revenue, because that would be different among alternatives. And again, so we need to know what's going to be different. That's from a financial aspect, from a financial point of view. What will be different among the alternatives? Okay, three types of costs that we want to talk about is first of all, there's a sunk cost. A sunk cost. I don't think we can jump to the thing here. No, it's the textbook definition of a sunk cost is it's a cost that is from a past decision and cannot be avoided or changed. Sunk kind of think of it as sunk. It's gone. It's gone, and we'll never get it back. Regardless of what I do, I'll never get it back. Let me give you an example of a sunk cost. And maybe I'll draw it out in a picture. Maybe it'll be easier to see. Okay, here's what our decision is. Suppose that I'm planning to go on a vacation and I'm planning to stay in a hotel, and so I put down a deposit. Put down a deposit on a room here in this hotel, and it's a non-refundable deposit. So I put down $500. $500. And when I get there, I've got to pay, I'm supposed to pay another $2,500. So it's going to cost me $3,000 to stay here for, we'll say, I don't know, 10 days or whatever amount of time it is. But this is what it is. This was a deposit, non-refundable. Going to have to pay $2,500 when I get there. Now, before I get there, I find that there's another room, and it's right next door. Maybe it's right next door. It has the exact same accommodations, same hotel, same view, same everything. But this I can get for $2,200. $2,200. Now, so my decision is, wow, should I stay in this room and pay the $2,500 to stay in this one, or should I pay the $2,200 and stay in this one? Now, the incorrect way of thinking, and a lot of people would think this, and I'm kind of surprised that sometimes my initial thought is this as well, is, well, I have to stay in this room because if I don't, then this deposit was worthless. Then, dang, had I known this prior to doing this, I would not have paid that deposit. But, gosh, now I have to do it. I'm locked into it, or I'm going to lose this deposit. Now, think about this. This is a non-refundable deposit. Whether I stay here or stay here, it's gone. I'll never, ever get it back. This is a sunk cost because no matter what I do, it's gone. So it should not enter my decision-making process. If I stay here, I paid $500 for a deposit. If I stay here, I paid $500 for a deposit. The only relevant costs are these. This is what's going to be different among those two alternatives. I can either pay $2,500 to stay here or $2,200 to stay here. Which one should I do? Well, obviously, this is where I should go, because this is cheaper. Now, again, in the back of my mind, I'm thinking, well, darn, I wish I wouldn't have done that, but it's a sunk cost. It's a sunk cost, never to be gotten back. So I can either spend a grand total of $3,000, or I can spend a grand total of $2,700. So this tends to cloud the decision-making process by considering sunk costs. So we don't want to consider sunk costs. Now this is more of a sunk cost that we come across in our personal lives, but the probably one of the most common examples of a sunk cost in business is the purchase of a machine, the purchase price of a machine, or the purchase price of a fixed asset. We buy that asset, and we purchased it, planning to use it for several years. And now after a year or two, we may consider replacing it. The cost of that asset is a sunk cost. We should not be looking back at the cost of that asset. So it may be something like this. I buy this asset, we'll put it on wheels, and so it cost me $5,000. That was my cost. And I plan to use it for several years as time goes by. But now, at some point in time, I may consider replacing it. With a newer, more efficient machine, perhaps. A little bit more efficient. What I want to know is, what will be different going forward at this point in time? How much will it cost to operate this machine versus how much will it cost to continue operating that machine? This may be cheaper, where this draws more electricity and the maintenance costs are going to be more. But should I consider the cost of the old machine? And the answer is no, I should not. That's a sunk cost. How about the cost of the new machine? Is that a relevant cost? And the answer is yes, it is. The cost of the new machine is a relevant cost, because if I replace this machine, well, then I spend $7,000. If I don't replace this machine, then I don't spend $7,000. You see how that works? But is this a relevant cost? No. If I replace this machine, if I replace it, it costs me $5,000. If I don't replace it, it costs me $5,000. Oh, not a relevant cost. So this is a relevant cost. Those are relevant. The operating costs are different depending on whether I continue using that one or buy a new one. This is a relevant cost. There's one other relevant cost as well that's different, is that if I do replace this machine, then perhaps I can just sell this machine. I can actually sell it to somebody for $1,000 and get $1,000 for it. Is that a relevant item? And the answer is yes, because if I replace this machine and spend $7,000, then I will get $1,000 for this one. If I don't spend the machine, or if I don't buy this new machine, I will not spend the $1,000, and I will not, or $7,000, and I will not get this $1,000. So the relevant items in this decision making are: what's it going to cost for the old one? Will I get it? What's it going to cost for the new one? What am I going to get for the old one? And what are the future operating costs associated with it? But this is a sunk cost, not to be considered, because it has a tendency to skew people. They may say, well, if I do buy this machine, then I've lost this $5,000. Well, hey, headlines, extra, that $5,000's gone already. Okay. What other kind of costs? What are the second types of costs? I'm going to zip up here real quick without stopping this. The second one is out-of-pocket costs. Now, out-of-pocket costs are certainly those are obvious costs. That's the what you have to actually write a check for, or you have to spend money on in the future as a result of a decision. For example, if we buy if we currently have a delivery truck and we're thinking about replacing it, we're going to replace it with a more fuel efficient one. So gasoline costs will be less if I do replace this truck. Well, then those future out-of-pocket costs, the costs of the gasoline, that's a relevant cost, because they're going to be cheaper. There's going to be less out-of-pocket costs if I do, in fact, replace that truck. Excuse me. So out-of-pocket costs are obviously a cost as well, and if they are different, they will be relevant. Now, insurance is an out-of-pocket cost. You have to pay for insurance on the truck. So if I replace the truck with a new truck, yeah, the gasoline costs are relevant because they'll be cheaper with the new one than on the old one. But suppose I contact my insurance guy and ask him, hey, if I replace this truck, will my insurance be different? And he may say, nope, same. The insurance will be the same. Well, then that is an out-of-pocket cost, but that out-of-pocket cost would not be a relevant cost because it's not different among the two alternatives. So out-of-pocket costs can be relevant or irrelevant. We just have to analyze it and find out, will they be different among my two alternatives? The third type of cost we're going to look at here is the opportunity cost. Now this is a cost, but it's kind of a hidden cost. It's harder to see. And it's easy to miss because it's harder to see. It's not actually a cost. It's not something I'm going to have to write a check for or that I'm going to pay. It's actually a missed opportunity. An opportunity cost is a potential benefit lost. That's what it is, a lost benefit. Let me give you an example of what an opportunity cost would look like. Opportunity cost would be something like this. Suppose that I'm, and I work, here I am working, and just like I work here at the firm, and for every day I work, I make $400, $50 an hour, 8-hour day. I actually make $400 going to work, and if I go to work for the day, hey, $400. If I don't go to work, I just don't get paid that day. Now, I have a friend that says, hey, you know what? There's a new snowfall up on the mountain. Let's go skiing. Let's actually go skiing. And because it's a weekday, the ski resort, they're offering lift tickets. It's only going to cost you $50 to go skiing. So wouldn't that be great if all we did was if you just blow off work today and we go skiing, it's only going to cost $50 for a lift ticket. Well, actually, and I think some of you are already tapping into this, it's going to cost a little bit, it's going to cost me more than $50. What overall, what's it going to cost me to go skiing? Well, here's my choices. I can either stay, or I can say, no, I'm just going to go to work and make $400, or I can go skiing and spend $50. What's the swing there? Well, this is an out-of-pocket cost because I've got to spend that. That's an out-of-pocket cost. And this will be, if I go skiing, I don't make this $400. This is an opportunity cost. It's a lost benefit. By making this choice, I don't get that benefit. So overall, what's it going to cost me? How will it affect me financially at the end of the day if I decide to go skiing? I'm going to be down $450. Can you see that? I could either, at the end of the day, I could have $400 in my bank account, or I could have $50 less in my bank account. Now, this is pretty easy to see. Most people would miss this and just say, oh, it's only going to cost $50. That's all it's going to cost me? Let's go. It's going to cost me $450. Now, for businesses, they have limited resources, limited space, limited machine time. So, and many times they have opportunities to accept different jobs. So what we need to know is we need to analyze decisions to make sure that we recognize that by making one decision, we may be giving up the opportunity for something else. For example, if I have an empty warehouse and I'm leasing it to somebody, so I'm getting rent payments for it. If I'm thinking, well, you know what, we need to stow in some additional inventory. Christmas is coming, so we're going to bump up production, and so we're going to need that warehouse. What's it going to cost me to use that warehouse? Well, nothing. I own it. It's not going to cost me anything to use that as storage. Well, it is, because I'm not going to have to pay anybody to use it, but I'm going to be giving up that rent that I'm getting right now. So that is a cost. An opportunity cost is a foregone revenue by making one choice over another. So that's what an opportunity cost is. So going back to the chapter here, the different types of costs that I'm going to be considering are sunk costs, which are irrelevant. Sunk costs are not relevant costs. We're going to consider out-of-pocket costs, which can be either relevant or irrelevant, because it just depends. Is it going to be different among my decisions? And then an opportunity cost is a relevant cost because it's a foregone opportunity for making a choice. Okay, so I'll let you kind of watch these videos. That's what they're there for. Okay, so the manager decisions that we're going to make. I think we'll go through the first couple here, and then we'll cut off the video and then pick it up in another video, just so they don't get too long. So here's an example that they're looking at here, is that sometimes businesses have to make a choice as to whether they should accept a special order at a special price. Because maybe we're selling a product for $10 a piece, and I think that's the example here, that's $10 a piece, and that's what we're selling them at. But then we get a special order from someone, and they want to pay us $8 a piece. So we need to make a decision. Should I accept this additional business at a lesser price, or should I not? Well, what are the relevant costs and revenues associated with making this decision? Okay, here's the example. Right now we've got a company that's operating at 80% of capacity. That just tells me, well, we can do a little bit more business if we want to. So we still have 20% idle time. We're not at 100%. If we're at 100% capacity, well, then an additional order, I don't think that's probably even a choice. I don't have the resources to fill that. But in this case, we're at 20% capacity. At this level, we make and sell about 100,000 units, and we sell them for $10 a piece. And each one of those is providing a profit of $1. Broken down like this. They've just said that if I sell 100,000 units at $10 a unit, here's my variable costs. Materials to make that unit, labor, variable overhead, and the selling expenses that are variable. So those are the costs that I incur for every unit I make and sell. So I have a contribution margin of $2.40. And then I have my fixed costs, which are, this is what's constant. Remember now, in variable costs, these are what are constant. And if I decide to make more, the totals are going to go up. But in fixed costs, this is what's constant. The totals are what are constant. And here they're just spreading my fixed overhead and my administrative expenses over the number of units that I'm making and producing, which is 100,000. So that comes out to 60 cents for fixed overhead and 80 cents for administrative expenses. So when I take my $10 minus my variable costs for each unit, minus my fixed overhead cost per unit, I'm making $1 per unit. Okay, got it? Makes sense. Now, a current buyer, he offers to buy another 10,000 units, and he wants to pay $8.50 per unit, which is $1.50 less than the selling price. Now, initially, what would you say? Well, first of all, I can make another 10,000 units because I have the capacity to do it. But initially, someone who does not understand the nature and behavior of costs would say, well, there's no way, because I'm only making $1 per unit. If I sell them for $10 a piece, I'm only making $1 per unit. And if I reduce my selling price by $1.50, I'm going to lose 50 cents. Now, initially, that makes sense. That for someone who doesn't understand costs, they would reject that order. However, because that's what they're saying here is that they would reject it based on historical costs. However, we need to analyze this a little bit. What would be different? Would my revenue change as a result of this order? And the answer is yeah. I'm selling 10,000 units at $8.50 a unit. Would my variable costs change? Yes, they're variable. Would my fixed costs change? No, they would not. So let's analyze this and break it down and see what the proper decision to make is as a result of this. They say that the variable costs per unit are $3.50, $2.20, and 50 cents for overhead. So those would be incurred. It says that selling expenses for this order would actually, even though on my regular business it's $1.40 per unit sold, because this is a one-time deal, it would only be 20 cents per unit, which is less than the selling expenses. So even the variable cost would be less for this particular order. Fixed expenses would not change. However, there would be an incremental administrative expense of $1,000 to work up the paperwork on this order. That would be different. So what would in fact be different here? Well, my revenues would be different. I would be getting $8.50 per unit, where if I don't accept it, I would not. So that's different. These variable costs, $3.50 materials, $2.50 labor, 50 cents overhead, 20 cents selling expenses, that would be different. Fixed overhead would not be different, but this $1,000 would be different because I'm going to incur that if I accept the order. It's maybe getting an attorney to write up a contract or something. So they break it down this way, and they say that this particular order will provide 85,000 more revenue, 10,000 units at $8.50 per unit. I will incur additional materials, labor, variable overhead, and selling expenses at 20 cents per unit. There will be no fixed cost. This is a sunk cost, will not change. And the administrative expenses there'll be $1,000 administrative expense. So what will this order generate as far as the bottom line? It will actually generate $20,000 of additional revenue. So yes, I should accept this order. Initially, we would have said, no, don't accept this order. You're going to lose money on it. You're losing 50 cents per unit. No, what's different? What revenues will be different, and what costs will be different? What are the incremental revenues and costs? You almost have to lay it out and break it down to answer that question. Some additional factors, though, to consider here in this model is this. It does say another cautionary note. There's a cautionary note. One is that we want to make sure that accepting this business will not cause my current sales to decline. I don't want to sell 10,000 units to somebody and then have them put them on the eBay, and all of a sudden I see my current sales going down. So this is usually Special orders are when you sell it to like somebody around the world. I normally don't I just sell my current units domestically, but somebody in China or Italy or somewhere wants 10,000 units. Well, that will not affect my current sales. Yeah, I want to make sure it's not going to affect my current sales. I want to make sure also that that what is it? Oh, that my I do have the existing capacity. In this case, I did, but we may want to look at it and make sure that we're not going to be carrying overtime or that type of thing. So we want to look at the non-financial aspects like quality. Can I kick out this order and continue to maintain the quality of the product? But this is just an example of incremental decision making. And yes, we should accept that order at 850. We can't sell all our units at 850 per unit, but I can sell these. So that's a additional business. Special order, special price. Now, make or buy. That's another decision that I face in decision making. This class is all about manufacturing, and so if I'm manufacturing automobiles, my manufacturing process does put together raw materials into an automobile, but I don't manufacture all the products all the everything that goes into this automobile. For example, the Ford Motor Company, do they make the tires, also manufacture the tires that go on their car? And the answer is no, I don't think they do. I think they buy those from Firestone or Michelin or somewhere like that. Could they make them if they wanted to? Probably. I guess Ford could open a rubber plant and make their own tires, but they've decided not to do that. So in the manufacturing process, we have to decide just how in depth do I want to take my manufacturing? Do I want to if I'm making tables and so I'm cutting the wood and making sure it's all beautiful, and then I glue it all together. Do I want to make my own glue or make my own nails, or am I going to buy that? Well, usually we're going to just buy that. So that's the decision we want to make here. Is that do we want to make a component part, or do we want to buy it? So let's look at an example here. We'll walk through this example together. Let's see. Okay. Fast Track currently buys some part which is a component from someone else. Maybe it's I think something in my head is telling me it's like an ignition switch that goes on a scooter or something like that. Okay. We buy it for $1.20 a piece. We find that we have some excess productive capacity. We've got some empty space in the factory, and we're thinking about making it instead of continuing to buy it. And the question is, am I going to be able to make it for cheaper than what I'm buying it for? We've done some analysis, and we've determined that the direct materials to make it, if I buy the materials to make it myself, it's going to cost 45 cents, 50 cents for labor, and my normal predetermined overhead rate is 100% of direct labor costs, which is another 50 cents. So 45 cents for materials, 50 cents for labor, 50 cents for factory overhead. Those are the three production costs in making anything. If management incorrectly relies on that, on breaking that down, the $1.45, notice here, materials, labor, and overhead, $1.45, they would conclude that, let's just keep buying it, $1.20, because it's going to cost me $1.45 to make it. But not all of these costs are incremental. The materials are incremental. That's different. The labor is, but not all the overhead is. Only incremental overhead costs should be considered, only those. So what they do is they do an analysis, and they say that of this 50-cent overhead rate, 20% of it's variable, the other 30% is fixed. Remember, overhead is variable and fixed. We even saw that back here in this example. Where was it? We had our variable overhead, and we had our fixed overhead. Actually, I think it's back here. Here it is, variable overhead and fixed overhead. Yeah, which one's the incremental one? Which one's the one that's going to change? Only the variable. So in this example, they've got total overhead of 50 cents, but only 20 cents is variable. So, did I go by it? Sorry, I know I'm probably getting you seasick. Oh, it is down here, buy, sell. Okay, sorry about that. Here we go. So, if I continue to just buy it, it's going to cost me $1.20. If I decide to make it, notice I don't have that $1.20 cost anymore, but I will have direct material cost per unit, a direct labor cost per unit, and an overhead cost. So, which one should I do? Should I make it or should I buy it? In this case, financially tells me I should make it because I can save a nickel a piece. Yeah, save a nickel. So it's cheaper for me to make it. Now, what are some of the additional factors, the non-quantitative factors? Well, one is this, quality. Can I, even though I can make it cheaper, can I make it as good? Can the Ford Motor Company make tires as good as Firestone, who's been making them for over a century? Well, that's one thing I have to consider, is that I might save a nickel, but if I can't maintain the quality, that's going to be a problem. Likewise, if I'm making them myself, I can control production. But if I'm buying them, sometimes orders that I'm waiting for this component part so I can finish my product, and these are on back order. So I'm actually relying on somebody else to fill orders, where if I make it myself, I can better control the delivery of that product. So sometimes that's a factor as well. So it's, both ways. Can I maintain the quality even though I'm going to have more control over it? Can I maintain the quality? These are things that have to be considered. But initially, strictly from a financial point of view, and as the accountant, I would provide this information. Say, well, it's cheaper to make it. Now you guys decide whether that's something that you want to do or not. So, yeah, that's an example of something that we would need to do. We're only at 36 minutes. Let's do one more section. Okay, scrap or rework. This is when I end up with some defective products. I've got a manufacturing process, and most of the products that are kicked off the end of the assembly line are good to go, but sometimes we may find some defective products. What can I do with those? I can either scrap them, throw them away, or sell them as defects for a much less of a price, or I can invest a little bit more money in them, put them back into the production process. It's going to cost me a little bit more money to fix them, but if I do fix them, I can sell them for maybe I can sell them for their regular price again. So that's going to be my decision. Should I sell them right now as is, or should I fix them and send them on? So let's look at the example here. Again, we're going to be looking at the relevant costs of this. It says, to illustrate, Fast Track has 10,000 defective units. So remember, they make 100,000 units each, whatever it is, month or year, whatever that was. But they're making 100,000. 10,000 are defective. And defective units of a product that already cost $1 per unit to manufacture. These units, right, what does that mean? Let me see. Assume the Fast Track has 10,000 defective units of a product that have already cost $1 per unit to manufacture. Okay, I guess, well, it cost me $1 a unit to make them. These units can be sold right now. They're defective. I can sell them for 40 cents a piece. Or they can be reworked for an additional 80 cents and then sold for their full price of $1.50. So I normally sell them for $1.50. So I guess that's what we're looking at. On a regular unit, I sell them for $1.50. They usually cost me $1 to make. So I usually make 50 cents a piece on them. These 10,000 are defective. So I can sell them right now for 40 cents each, or I can put another 80 cents into them and sell them and fix them and sell them for their full price. Now, first of all, this $1 per unit, is this a relevant cost? And the answer is no, it's not. Let me lay this out visually real quick for us. So these units usually cost me $1 to make, at which point I can sell them for $1.50. But I've got some defective units that are at issue. Here's my choices. Number one, defective units, I can either sell them right here for 40 cents a piece, or two, I can add a little bit more money to them, rework them at a cost of, how much did they say? 80 cents a piece. 80 cents a piece, and then I can sell them for $1.50, for $1.50. So here's my choices. 1, I can do that, or 2. I can rework them 80 cents a piece, $1.50. Now, first of all, recognize, is this a relevant cost? And the answer is no. That's a sunk cost. Whether I sell them right now, they cost me $1. And whether I rework them a little bit, that dollar is still there. So that is not a relevant cost. What's different? Well, I've got a incremental revenue. If I rework them, my revenue will be different by 90 cents per unit, and I have an incremental cost. 80 cents is there if I rework them. It's not there if I don't rework them. Yeah, so I either incur this cost or I don't, so it's an incremental cost, and as a result of my decision, the revenues will be different. This is not a relevant cost. Oh, it's a cost. It's just not relevant to this decision. So that's the choice I need to make. So they go through and they say, well, what would be my revenues if I scrap it 40 cents, rework it $1.50, less the out-of-pocket cost of 80 cents. And here's where they reflected and now if I stopped right there and didn't have this opportunity cost, if I had the excess capacity to rework them and I could do that, then yes, I should do it, because what is it? Oh, it's $1.10 more, $1.10 more revenue for incurring 80 cents more cost. I should do that. Yeah. My incremental revenues are greater than my incremental costs. But in this example, they actually recognized an opportunity cost. They said that if they rework them, because they are operating near their maximum capacity, they're already filling pretty much all their capacity, reworking those items, throwing them back into the manufacturing process would mean that Fast Track would be unable to manufacture 10,000 new units. So if they are foregoing the opportunity to make those new units, how much do they normally make on these units? Remember, they make a 50 cents a piece. They sell them for $1.50 and they usually cost $1. So I'd be foregoing the opportunity to make 10,000 brand new units and make 50 cents a piece on them. So that would be an opportunity cost of reworking them. I would get $1.50 for the scrapped units, cost me 80 cents, but I'd lose 50 cents on time that I could spend making new ones. So in this case, if there is an opportunity cost associated with it, I don't have the excess capacity to do it, then we should just sell these for scrap and keep going, because the incremental net income is 40 cents for scrapping them. But again, if I have the excess capacity and I don't have an opportunity cost, then I should rework them. So that's important to recognize there. So scrap or rework. What would be different? How would my revenues change, and what would my costs be, including any opportunity costs of devoting time to reworking these things? Okay, next one is sell or process further. I'm going to go back a little bit and just see where we are in the chapter. We've talked about costs versus benefits, incremental and relevant costs, special orders, make or buy, scrap or rework. Now we're just going to talk about, we have what, 1, 2, 3, 4, 5 more. I think that'll make a good video. So I'm actually going to make that tomorrow morning. I think so. Today is Wednesday. I don't know when you're going to be watching this, but today is Wednesday, May 6th. I'm going to make it and load it tomorrow morning so that this entire chapter will be available to you. And then over the weekend, I'm going to make the video on the chapter 24. So hopefully this is helping out. Please, go through the examples in the chapter. I know we're going through them, but then watch the little videos that they have as well, and we'll pick this up again in video 2. So hope you're all being safe and wearing your masks as you should, I guess. And I understand we have to wear them in stores now, but I'm doing what I can to stay healthy and just to get through this semester. So hang in there, gang, and I'll connect with you on the next video.